Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone, and welcome to Accredited Investor Markets Radio. I am your host, Christopher Cahill. Later on, we'll be speaking with Alan Kors, founder of Achieve Lending. Achieve Lending is an online presence which matches students of any age with borrowing opportunities from lenders who are surprisingly various. Thus, students will become informed consumers as well as borrowers. I wish something like that existed when I was financing my education. I wonder if I would have been wise enough to take advantage. But first, let's review some relevant recent writings. Privco. The Privco Deals Digest of July 23, 2015 reads as follows, or at least one entry is, KKR and Borealis Maritime have formed a joint venture to acquire Hanseatic Ship Asset Management, a Hamburg, Germany-based fleet of container and dry cargo vessels, which is a subsidiary of Commerzbank AG, for $254.5 million. Well, my first question is why? Why make such a purchase, such a massive investment? With China slowing down, you'd think that the container shipping and dry cargo shipping business would be slowing down as well worldwide. So demand should be slower. Though fuel costs certainly are down, maybe costs being lowered helps make it more viable. But I'd like to make some larger comments about the name of the company that was acquired, Hanseatic Ship Asset Management. Hanseatic Ship Asset Management is named for the Hanseatic League, and now I'm going to read bits and pieces from Britannica Online Encyclopedia. The Hanseatic League was founded by North German towns and German merchant communities abroad to protect their mutual trading interests. The League dominated commercial activity in Northern Europe from the 13th to the 15th century. Hansa, part of Hanseatic, was a medieval German word for guild or association. By the early 13th century, Germans had a near monopoly of long-distance trade within the Baltic Sea. The Hanseatic League attempted to protect its ship convoys, caravans, by quelling pirates and brigands. And as an aside, I do appreciate an article with the word brigands in it. And it fostered safe navigation by building lighthouses and training pilots. Another aside. The United States has fulfilled much of this function with regard to world trade on the high seas since World War II. Unlike the United States, though, the Hanseatic League's aggressively protectionist trading practices often aroused opposition from foreign merchants. You see, and as another aside, the Hanseatic League purchased influence. It vindicated its interests by raising armies, even defeating the Danes at one point. Quoting again, in the 14th century, the Hanseatic League claimed a membership of about 100 towns, mostly German. The Hanseatic League declined, partly because it lacked any centralized power with which to withstand the new and more powerful nation-states forming on its borders. And that's the end of what I'm going to read. So history had its way with the Hanseatic League. Sic transit gloria, Latin for thus goes fame, or fame is fleeting. In the case of the Hanseatic League, sic transit. Will that be the fate of the KKR investment in the Hanseatic Ship Asset Management Company? Did KKR make a good bet, one could ask? It's a long-term bet. Or maybe thinking even longer term, will the United States continue to keep sea lanes open? Or is an era of diminished stability in that regard upon us? And what does that mean for long-term investment strategies? Well, just raising questions, not answering them. let's move from international trade to household management. And household management is a good place to go when you're talking about economics, because the word economics in its Attic Greek root means exactly household management. Oikos in Attic Greek being the word for household. But to get back, AccreditedInvestorMarkets.com, AIMkts.com, has an article posted August 5th, 2015, entitled, "To Address Financial Discontent in a Relationship, Follow the 3 C's." And we mean not high C's, but rather the letter C. The article is written by John Sweeney. John Sweeney is Executive Vice President of Retirement and Investing Strategies for Personal Investing, which is a unit of Fidelity Investments. We won't keep you in suspense. The 3 C's are communicate, collaborate, and control. Great, so we've gone from international trade to household management. The natural next step is poetry. And I refer here to original poetry by John Friedland. This poetry can be found on AIMkts.com in an article playfully entitled, "The Doctor and the Drug Dealer," a parable in 4 stanzas about registered investment advisors and broker-dealers. The article itself, with its playful title and its poetry, is a useful and lively entry into the debate over proposed Department of Labor rules intended to raise the standard to which broker-dealers will be held in giving advice on retirement investment. So quite apart from the substance of the article, which is important. We'll have to have an Accredited Investor Markets Radio poetry slam at some point, if other financially minded bards will just get busy. Meanwhile, over on Business Transition and Exit Planning, a website also under the Financial Poise umbrella with Accredited Investor Markets and with this show, we find a very important article entitled, "Study Finds 4 of 5 U.S. Family Business Owners Lack Adequate Succession Plan." Earlier we had 3 C's. In this case, we have 3 D's. For this article has data which is discussed and delivered to you by BTEP. And it's an important issue. The importance of this issue was discussed on an earlier Accredited Investor Markets Radio broadcast in which I spoke with Jerry Mills. Jerry Mills wrote a book entitled The Exit Strategy Handbook. So there you go, strategies for exit planning. But Mr. Mills also noted that with the passing of the baby boom generation, no, they're not dead yet, but they are retiring, and their businesses have to move on to other hands. Their family businesses are to move on to other hands, whether within or without of their families. With that comes, a great deal of succession, a great deal of exiting, and therefore an opportunity for advisors, but also an opportunity for investors who can take the already working family business, take that capital, inject their own capital, and transform or continue a living economic entity. Well, let's move on to the interview. We have with us Alan Coors. Alan Coors is founder and chief executive officer of AchieveLending.com, the first student loan comparison tool. Still south of 30, Alan already has had a career in banking and now has made himself into a fintech entrepreneur. AchieveLending.com offers users a free online portal to search, find, and compare private student loans. Achieve Lending is designed to help both traditional and non-traditional students find the best private financing for educational purposes. Coors learned through his own experiences and the experiences of others that students make poorly informed choices when it comes to student loans. Such choices can cost thousands of dollars over the life of the loan, and that's real money. AchieveLending.com helps users find the most competitive interest rate, and educate users on the loan process and terminology. The loan comparison can take as few as 30 seconds through the online portal. To find out more and to browse student loan offers, go to achievelending.com. Welcome, Alan.
Thank you, Chris, for having me. Excited to be here.
All right. So you're a matchmaker.
Yeah, we operate a lot like Match.com or even OkCupid, one of the newer matchmaking services. Essentially what we do is we match prospective borrowers with lenders.
Okay, that's simple enough, and I think many of the people listening to this program have gone through the student loan rigmarole in going to college. So we understand the demand side, whether the students are traditional or non-traditional. But where are all these incipient lenders? Just my own experience was a fog of a few large institutions might have been out there supplying money. I don't know. They handed me a form and I filled it out. But I think your model is premised on there being many active lenders on the supply side.
Indeed, that's exactly right, Chris. So, there was a time when, there were just a handful of lenders really dominating this market. Even today, the top three, Sallie Mae, Discover, and Wells Fargo, take about, 70-75% of the market share themselves. But what we're seeing now is a lot of new players, particularly in the private side, coming into the space with really progressive options for students. So not only, economically are they more advantageous than the Sallie Mae's and the Discovers, and even federal loans, subsidized federal loans in many instances, but they come with such, qualitative benefits like coaching, mentorship, much better, more hands-on customer service and things like that. And really what our platform does is it shines the spotlight on those solutions and helps them compete with the Sallie Mae's and the Discovers of the world, even though their marketing budgets are much smaller.
So you're drawing into through your portal, you're drawing in lenders who would not get as much attention otherwise. Is that right?
Absolutely.
So in a sense, you're sort of an Uber or Airbnb, right? I mean, there's capacity out there, and you're finding a way to bring that capacity into the market.
Yeah, I think that's a good analog.
All right. Well, how do you get paid if it's a free online portal to the borrowers?
So it's a free online portal to borrowers, and our view when it comes to those borrowers is we want to be as objective and impartial as possible, right? That's the purpose. It's to objectively compare amongst a wide spectrum of options. So the lenders are our paying customers, and they already have, budgets for customer acquisition. They're often paying between, $400 to $900 to acquire customers, and in the instance of some of these big players, they're, still using direct mail and other antiquated methods. But for us, they pay us either for qualified applications. So an applicant submits a completed application, the lender likes that application, and they'll pay us, it could be as little as $50 to as much as several $100s. All they pay us for funded loans, and it could be either a flat fee or basis points, which means, a certain percentage of the funded loan amount.
That's interesting. And when you talk about the disinterestedness of your portal, I started thinking about the accusations that search services online will give preferential access to bigger players. And I'm wondering whether any lenders may try to seek preferential placement or something on a portal like yours.
We have had offers from everybody. So, as you can see in our platform, if you go to achievelending.com, for anybody that's listening to this, there is priority, right? There's a list. And as with any list, folks have certain biases when it comes to making decisions. They're inherent psychological sort of fallacies. And people often gravitate towards the numbers higher up in that list. Typically first or second receives the majority of the clicks. So we've had lenders offer us higher fees, an extra, $50 or $100 an applicant, or, higher percentage payments on the funded loans to appear higher in that list. But, it's important for us as an impartial tool that really is meant to empower the borrower and make this whole process transparent to, not take those fees and make it as unbiased as possible.
All right. Well, then that makes me want to inquire and maybe develop something you've already said. Without such matchmaking, was it just a few big gorillas dominating the field, and does that make you a guerrilla against the gorillas?
I love that play on words, Chris. So it was just a couple gorillas. I like to call them dinosaurs because those, three players, the Sallie Maes, the Discover, and the Wells Fargo, they've been at it for a while. They, rely on very antiquated marketing methodologies. They don't really care about the borrowers. They treat borrowers, in many instances just like, cogs in their machine, in their profit-making machine. And we've really gone out there guerrilla style and started causing a little bit of a ruckus where we're disrupting the space, and we have a lot of these new players, these progressive tools that, while they don't have the same marketing budgets, they are receiving some publicity. The SoFis, the Common Bonds, the Lenkeys, the Upstarts, they're all over all the startup magazines, and they're, at the forefront of the tech innovation arena, and we're helping them guerrilla style compete with the Sallie Maes and the Discovers. And those smaller players and the regional banks are thrilled about it.
All right, so let's get a little bit more toward the nitty-gritty. So in the matchmaking, what determines loan terms? Let me just throw out a few things. Personal wealth, family wealth, income, level of education now, level of education sought, type of education, status of school, Harvard versus something else, traditional university versus DeVry, non-traditional schools. Or, and then this made me think of cybersecurity. The type of trade for which a certification is sought, I wonder if a person, with decent background who is, decent educational background who's seeking a cybersecurity training is going to get lower interest rate on his loan because it's such a sexy field.
Yeah, so there's definitely correlations today, and terms are more advantageous for folks that are in, higher paying fields, or in fields where, there's better graduation rates when it comes to undergrad education and graduate school education. That's really the wave of the future, and we're strong advocates of taking a lot of those non-traditional variables, those non-financial metrics, and incorporating them into the underwriting process. So historically, and the dinosaurs, as I will continue to refer to them, the Sallie Maes and the Discovers, don't really rely on a lot of those metrics. They use more traditional financial underwriting procedures. But the startups in this space, the SoFis, the Upstarts, they do rely on a lot of this information. So the level of education you're seeking, what field you're going into, the area of study, job history, and a lot of other non-traditional factors, they play a role in determining your interest rate, your terms, certain forgiveness factors, and that's what we believe, truly embodies the future of pricing risk. And if you look at what these assets are, is it's an investment into an individual who's looking to, finance a piece of paper, right? That's what a diploma is. It's an investment, and in order to price that investment and assess the risk, it takes a lot more than just, W-2 and historical earnings today. Today, if somebody's going into a field that, happens to be extremely sought after, or if they have held, jobs in fields like that previously and have very strong job history and earnings potential, that should play a role and help them get better rates. That's what a lot of these newer players do.
I can't help thinking of Frederick March and his famous speech in the movie The Best Years of Our Lives. Granted, it's an old movie, but it won the Academy Award. And he comes back from the war after fighting brutally through the jungles of the Pacific. And he announces to his bank, of which he is a very high official, that they're going to start giving out unsecured loans to veterans, which really alarms the senior bank people. But he explains why. And I'm not saying that that is the kind of factor these upstarts are taking into account, but perhaps maybe there is an upstart out there taking, for example, veteran status into account.
There could be. I think certainly a lot of the veteran question and certain, public service questions will grant better terms or certain, forgiveness preference. Even current legislation does that for federal loans, if you're in public service, for instance. But I think, in my opinion, that's more of a token of gratitude for somebody that served, the government and the underpinnings of America's economy, as opposed to the other side, which is, we're going to get somebody a better rate because there's a better chance that they'll earn more money and pay back this term and make good on this instrument as opposed to fail to pay back. So it's kind of like another side of the coin. But, yeah, I think those variables, they're all important and they all require consideration.
Okay, so I assume then that there are wide varieties in terms, interest rates, whether they're adjustable or not. Are there chances to lock in? We're in a low interest rate environment now, lock in rates or not? Is there an opportunity to refi rates in a high interest rate environment if they get lower?
Absolutely, Chris. So there are certain lenders that offer fixed rates, certain other lenders that have variable rates, and many lenders that offer both. I think on the refinancing side, there's many players out there. I mean, it's a $1.2 trillion bubble. There's so many new options out there that focus exclusively on refinancing just because it's such a big market that's, captive and untapped and really, it's poised to explode, people are saying, so it needs to be addressed. And, depending on what your terms are, what your, qualifications look like, you can lock in, a better or worse rate. And in terms of range, if we just, let's say, analyze interest rates, for instance, it could be something as little as 1.5% with certain lenders and for the most creditworthy borrowers to up as high as, 15 to 20% for private student loans, all the way up to, 80, 90, 100% for shorter term financing for a less creditworthy individual. And that's not even, looking at something like a cash advance for somebody that's really strapped and needs the money ASAP.
Well, have any policy changes that have occurred under the Obama administration affected how this market works?
That's a great question. So I guess on a high level, the first point is Obama is making some changes. He has some initiatives planned as part of the Healthcare and Education Reconciliation Act. But those, before I kind of quickly touch upon what they are specifically, those address federal loans exclusively. And federal loans are about, 80 to 85% of the $110 billion in annual volume of loans that are issued each year. And the private market, if anything, continues to expand because of what a lot of these programs are doing and because of the compression that's happening in the federal sort of loan issuance market. But the two biggest things I would say are the income-based repayment plan, which ties repayment for a borrower to a fixed percent of discretionary income, and then also student loan forgiveness. And this rewards borrowers that have been responsible and have made their payments for a certain amount of time. It starts at 20 years to have the remainder, the remaining balance be forgiven. And it's actually, I think, 10 or 12 years for those that did do some public service.
Does that exert any downward pressure on the terms of private loan?
So on a high level, you would think that that's going to, the forgiveness there would have a downward pressure on the demand for the private loan market. But on the other hand, what's happening is the federal government is becoming far more stringent when it comes to evaluating who they lend federal loans to. Obama has proposed a rating system where you're going to compare schools on factors such as, how many students graduate, how much debt they accumulate when they graduate, how much money they make after they graduate, and ultimately they're going to use that rating system to allocate the billions in federal aid and grants to students. And what that's going to do is certain for-profit institutions that were, let's just say unscrupulous in their academic practices and, charging a ton of money for diplomas that weren't worth a whole lot are going to stop receiving aid. We've already seen that happen in schools like, Corinthian. There was a collapse in the Corinthian education system and other schools. And when the federal government cuts back on those schools, those borrowers, those students that then need to take out money are going to rely exclusively on private loans. So that's going to obviously expand the market. I think generally on a macro level, Chris, I would say there's sort of four key trends that shape the education financing market that Achieve Lending is playing in. First, it's the exponential growth of the cost of education. I mean, tuition has tripled over the past 2 decades. A second would be the ever-increasing student population, and by that we mean more and more students, a larger percentage of folks are pursuing a higher education just because it's more necessary to be competitive in the labor market. The third trend will be a cutback in government lending. As I said, the government's becoming more stringent and restrictive on loaning out education loans, and Achieve Lending is going to fill the gap when folks can't get the federal money that they used to qualify for. And then the last trend, the fourth trend, would be society's what we're calling championing of lifelong learning. And what that means is, education no longer means attending undergrad, potentially grad school, and then landing a job and holding that job for 30 years. Your education is done after the first 4 to 6. Education today has evolved drastically. It's a much more personalized process, and folks are continuing their education throughout their lives. And it could be, attending a conference or a trade school or taking an online class in, computer security or design or graphics or whatever it may be. And that education is something that Achieve Lending firmly believes in, and that's the type of education that we will help folks finance as well.
Well, it just occurred to me, especially the final comments you made, that employers might have a role in, well, at least getting their employees to take out loans through an Achieve Lending process. Is there any involvement between Achieve Lending and employers, not as customers, but as quasi-customers?
So employers would definitely serve as a strong intermediary because the short answer would be we haven't yet partnered with any employers. I mean, we're still early. What you see on our website is essentially a prototype. We've just been able to generate a lot of traction off that prototype. But as we expand, the continuing education market on the employment side, when it comes to certifications and specializations, it's a $47 billion a year market. And in addition to the annual market for traditional loans, we think that market is very attractive, very sort of ripe, and poised to continue to grow, and we'd like to play a role there as well.
I was reading a Matt Levine column in Bloomberg, and he quotes somebody named Dan Davies, whom I do not know, but it's about fintech. And Dan Davies wrote, and Matt Levine quoted, "Several fintech startups have already found out that there's no exemption for tech companies from the money laundering or consumer finance laws, and that regulators usually don't care if they've driven someone they regard as a rule breaker out of business. But that really doesn't apply to you. You're not fin as much as tech in a way, right? I mean, you're not doing the lending."
Right. So we're a search engine, just like if you look at a great example would be Kayak. Kayak isn't in the travel space. They're a meta search engine that enables folks to find airfare at the cheapest rates by, canvassing the web and comparing all the different options. And we're basically the same thing. We're a tech play. We're a search portal that looks at all the different lenders. We don't have a balance sheet. We're not lending out our own money. And we just help folks compare, regardless of what they need, amongst a wide variety of alternatives. And that's our sole purpose. It's to empower people to make informed decisions and to have proper knowledge in advance of making that decision.
All right, so let's wind it up then with an entrepreneur question. You said somewhere, quote, "None of your friends had ever built a real business, and we came from very conservative institutional backgrounds," end quote. So how is it you started doing this?
The short answer would be I had, worked at, let's just say, some of the most prestigious institutions at each stage of my career. So whether it was investment banking or it was private equity or angel investing, I'd always been sort of at best-of-breed firms. And what I found was while it was always interesting in the short term, I was never continually challenged, nor was that fulfilled. I was looking to build something, bigger. I wanted more of a challenge. I wanted to build something more impactful, and I knew I could. So, really this was a function of me scouring all the different alternatives and not being fulfilled by any of those options, and knowing that, I wanted to build something of my own that contributed to society and provided value to society while also stimulated me to seeing a big opportunity in student loans, seeing how making the wrong decision affected me when it comes to my student loans. And all that really, triangulated into right time, right place, and I had some good mentors at the time that encouraged me to pursue this dream, and that's why we're here today.
Well, Mr. Alan Kors of AchieveLending.com, it's been a pleasure.
Thank you so much, Chris. It's been a pleasure as well.
You've been listening to Accredited Investor Markets Radio. You can find older interviews on AccreditedInvestorMarkets.com. Accredited Investor Markets Radio is produced by Stephanie Strait. Let's do this again sometime.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.